From a purely systematic and cyclical standpoint, a strong case can be made that commodities and hard assets, specifically energy and selective metals, remain structurally undervalued relative to equities. While individual tech and semiconductor names have driven massive multiple expansions, the broader macro environment has left a stark, multi-year divergence in valuations between paper assets and physical raw materials. Here is why this pocket of the market presents compelling asymmetric upside. 1. The historical equities to commodities ratio. When you look at the long-term macro cycles, the ratio of the S&P 500 to a broad commodity index, like the Bloomberg Commodity Index, shows that physical assets have spent the last few years hovering near multi-decade relative lows. Historically, capital moves in massive multi-year waves. We have experienced an extended regime of equity outperformance, fueled by megacap tech expansion. When inflation threats remain persistent and geopolitical supply shocks disrupt global logistics, capital mechanically rotates toward the spine of the physical economy, energy and raw materials. 2. The AI power surge meet macro energy. There is a massive structural blind spot in the current tech rally, the power grid. The projected exponential growth of data centers requires an unprecedented amount of base load electricity. While renewable energy is scaling, the immediate, reliable bridge to power these facilities over the next several years falls squarely on traditional macro energy, specifically natural gas and heavy electrical infrastructure commodities. This creates a highly constructive backdrop for the energy sector. It is no longer just a cyclical play on global GDP growth. It has quietly become an essential infrastructure layer for the digital economy, yet it still trades at a fraction of the valuation multiples seen in tech software. 3. Hard assets versus currency degradation. With global sovereign debt continuing to expand, hard assets act as the ultimate mechanical hedge. Gold has led the charge by breaking out to historic highs, driven largely by aggressive central bank accumulation. What makes this interesting is the catch-up potential for secondary industrial metals like silver. The gold-to-silver ratio recently compressed dramatically toward the 60-to-1 range after hitting steep extremes above 100-to-1. Historically, when silver begins its mean reversion catch-up phase during a hard asset bull cycle, its smaller, more volatile market structure allows it to move with massive velocity relative to gold. Combined with an ongoing physical supply deficit in the silver market due to industrial solar and electronics demand, the structural upside remains highly asymmetrical.